Welcome back to the platform for investor education. This topic introduces you to different institutional investors and the sometimes complex trading and investment strategies that they employ. Why should you care about this as a retail investor? The answer is that institutional players account for over 80% of the daily trading volume in equities. Their actions impact prices, even set them. Remember my old line, prices do not move, they are moved. So let us learn a little more about what these guys really do. First, hedge funds. These are pools of money like mutual funds but organized as partnerships. They tend to carry substantial amounts of leverage and often have exposures to illiquid investments. Some of this leverage comes from positions in derivative instruments such as futures and auctions. Illiquid essentially implies that exiting large positions is difficult without offering substantial price discounts. Unlike mutual funds, therefore, hedge funds frequently require that their investors commit to leaving their capital in the fund for a long period of time. This is known as a lock-up period, and multi-year lock-up periods are not uncommon. The standard cost structure for hedge funds is known in the industry as 2 and 20, which accrues to the managers. This refers to 2% of assets as a management fee, and 20% of the performance generated by the fund goes to the managers themselves. The term hedge fund is actually quite misleading. Rather than hedging their risks, they really are more about maximizing returns from identifying, even discovering, investment opportunities outside the beaten track. One could also classify hedge funds in terms of the strategies they follow. Some, for instance, label themselves macro funds, implying that they take big bets on the future state of some economies and even on the future direction of interest rates in one or more regions. Other hedge funds label themselves as quant funds, meaning that they employ quantitative strategies in their attempt to generate superior returns. You may even have heard of asset reconstruction companies or ARCs in India that attempt to take on low-rated loans of Indian companies, even attempt then to recover some portion of loans in default and generate a profit from that kind of activity. The second group of institutional investors that merit attention is private equity. Private equity, or PE, refers to equity that is not listed on any stock exchange. These PE funds typically take large stakes in private companies, sometimes even buying them up outright. These funds invest for the longer term and take larger risks than the mutual funds that we are familiar with. Private equity activity can include buying distressed companies and providing management services to maximize the chance of that company's turnaround. It can also include investments in emerging sectors of the market and is accompanied by a focus on new technologies. Current favorites are renewable energy, social media. The distinction between venture capital funds and private equity funds is blurring in India now as in other parts of the world. In the past, the VCs of venture capital funds were once exclusively geared towards the risky funding of young entrepreneurial startups. But now PE funds are playing a bit of that game too. The third group of institutional investors that I want to bring your attention to are sovereign wealth funds. These refer to state-owned pools of capital which are invested to benefit that country's economy and its citizenry. Some of these sovereign wealth funds employ money generated from oil revenues. In this regard, Norway's government pension fund is about the largest at close to $850 billion US. The China Investment Corporation, a more recent entry, seeks to diversify its holding of foreign currency assets. Singapore's Temasek Holdings might be another familiar name in India. India too has been talking about starting a sovereign wealth fund of its own. The fourth category of institutions are pension funds. As that name implies, pension funds are investment pools that have commitments to make payments to retired employees. These can be public or private. They're usually managed conservatively with large holdings in bonds. For instance, the Employee Provident Fund of India, EPF, is the 10th largest pension fund in the world, but the bulk of their portfolio is committed to GSECs and state development loans. Recently, they have been permitted to invest up to 10% of new inflows, not the corpus, into the Nifty and the Sensex. Even this new inflow recently amounted to about 70,000 crores annually. Outside India, the larger pension funds are able to direct small portions of their assets into riskier investments in the hope of generating a large return as well. It is not uncommon to see Danish pension funds invest in water infrastructure projects in India. In recent years, India has seen an influx of capital from many of these entities I just described. Our regulators are actually putting together guidelines to determine the types of assets these entities can hold, the length of time they must hold them, the types of investors that they must attract, among other things. In conclusion, there is also one other trend that I see taking hold in India, one which is popular in many parts of the world and is therefore worth mention. These are strategies employed by so-called high-frequency trading funds. Their purpose is not investment, but trading to exploit very short-term investment opportunities. With the support of technology, they are able to execute trades in time spans as short as milliseconds. To sense how fast this is, let me tell you that it takes about 300 milliseconds for you to blink your eye. To facilitate this kind of activity, these high-frequency funds pay to locate their trading computers close to the central server of the exchange on which they operate. You may have read recently of co-location and recent goings-on at the NSE. That is what this means. Almost all these activities are directed by super-fast computers. The role of the human is relegated to turning off the lights, locking the doors, and providing janitorial services. Just be careful that you don't end up trading against these guys. And as always, come back for more.